Hey, what's going on, everybody? This is Derek Nelson, PolarisFinancialNetwork.com. My book is available on Amazon. It's called The Financial Foundation System, or you can visit financialfoundationsystem.com and get the ebook absolutely free. And I got to tell you, there is invaluable information contained within the pages of those books to help you not just get out of debt, but maximize your savings without even having to alter your lifestyle. And part of something that's in that book that I want to discuss today, and by the way, you find value in what I'm about to tell you, hit the subscribe button so you will be notified when I have new videos coming out. Give it a like, give it a comment, and give it a share. We want to spread this message across the entire United States of America. So in today, what I want to talk about is the 3 ways that we could typically purchase a car or a vehicle, SUV, whatever you're doing. But auto vehicles, every few years we're going to need a new vehicle. Some of us a lot sooner than that. Some of us will ride a vehicle off into the sunset. But whatever your goals are, I'm going to show you the 3 ways that you can get yourself a new vehicle. Stay tuned. All right, so let's talk about the 3 ways to purchase your next vehicle. Let me put this into presentation mode and we'll be ready to rock. So, I know you know of 2 ways, and we're not talking about leasing, we're talking about strictly purchasing. And I know right off the bat, you know of 2 ways that you could do this, but I'm going to show you a 3rd way that is extremely powerful. Okay, so let's talk about the first way we can do purchase our next vehicle. Basically, we could purchase it outright, right? Depending on the cost of the car, if you got $25,000 in the bank, $30,000 in the bank, $50,000 in the bank, depending on what your budget is, you could take that, you could cut a check to the auto dealership and purchase a car outright. Now, there are some pros to doing that, and my favorite thing is I got no payments, right? Okay, I don't pay any interest. I mean, that's a win-win for everybody. I got no payments and I pay no interest charges, and that's absolutely huge in my mind. However, here's the problem. There is an opportunity cost. And what that means is, what if you have the opportunity to go in on somebody in, let's say a rental property, for example, and you need $20,000 to buy into it, except now you just took $25,000 out of your account to purchase a new car, which, by the way, is a depreciating asset. And now you have no money left to do something different. Or what if you have an emergency? If you have an emergency situation and you magically have to come up with money, could be anywhere, could be a new fridge, could be a new water heater, thousands of dollars potentially. And now you have to put that on a credit card potentially and now you're going to end up paying interest anyway, right? On that money that's an emergency. So the money's gone. You have a car, you fast forward 5, 6, 7 years, that money's long gone, you never see it again. And you have a 5, 6, 7-year-old car. So those are the pluses and the minuses about just cutting a check and buying a car. Now, the other option, and the most common option, is to finance it, right? I like financing because, you don't have to put a lot of money out of pocket. Maybe you put, some people put practically nothing down, right? But you could put a couple of thousand to lower your payments and what have you. We want the payments to be affordable, and hopefully yours are if you're in the process of in an auto finance, right? If you have an emergency or / opportunity, you have cash because you didn't lay it all out to buy the car on the front end, right? But on the flip side, you're ultimately going to pay more out of pocket. There is a cost to borrowing, correct? Yes. And the interest rate is going to be higher than what they tell you. I'll get into that in a minute. Now, auto loan debt is over $1.2 trillion in this country, which tells me the majority of people are absolutely financing, they're not purchasing. Why? We don't have the money sitting in the bank. Everything's financed. Think about that. Not only are we financing our cars, we're financing our phones. Everything is financed. Everybody sells everything on payments, right? Here's the most common loan, 6 years. That is the most common loan, with 7 years not too far behind. Used to be 5 years was the big one, but now that cars have gotten more expensive, we have to extend the terms of those loans to lower our payments. However, by lowering our payments, what we are also doing is paying more interest, believe it or not, and I'll show you that in a second. So let's talk about the interest rates. So I just took, round number, 25,000 we borrowed, 5%, 6%, 8%, right? Depending on what your credit score is. We did it over 6 years, 72 months, because that's the most common loan. If you pay 5% interest on 25,000 over a 72-month loan, your real interest rate is 16%. If you're paying 6% interest, you're at 19.3% interest. And if you're at 8%, you're really paying 26.2% interest. How, Derek, do you come up with those numbers? Well, I'll give you a little trick. You know that thing they call APR? That's the annual percentage rate. Their costs are associated with that. Think about that. As you're paying your loan down, your payments don't go down. Like for example, if you had a credit card and let's say your payment was $80 was the minimum payment, and you paid $100 into it, the next month your minimum payment might be $67, right? So those payments go down as the balance goes down. Not with your automobile. They stay exactly the same. So it's 6%, and I took the one in the middle. Your payments will be $414.32 a month, which means you're going to pay a grand total of $29,831 or $4,831 in interest. Now, if you divide, the original borrowed into the interest paid, that'll give you your real interest rate. So yes, if that's the case, you are paying 19.3% over the amount that you borrow. Think about that. That's a lot of interest. That's a credit card rate, right? We don't want to do that. So let's talk about our third option. And the third option is to become your own bank. This is what I do with clients. And it's not just to finance automobiles, it's to create a private bank so that your money constantly flows and you have access to it. Okay? So what you do here is you borrow the $25,000 out of your own cash value and you pay yourself back over time. The money continues to grow in the account as if you've never touched it. Okay, so let me make that clear. I'll give you an example. I have $50,000 in my cash value life insurance policy. I borrowed $25,000. Insurance company may charge you 4% or 5% to take that money, which is fine, because here's what they're also going to do. Even though you borrowed $25,000 from the insurance company, and that is a difference, and that's another conversation, but you're borrowing $25,000, they lower your cash value amount down to $25,000, but there's another bucket, and that still shows the $50,000. That's your accumulation. They will pay you interest and dividends on the entire $50,000 as if you've never touched it. And then you systematically pay yourself back as if it were a lender. And here's the difference. When you buy a car outright, the money's gone. When you finance a car in 5, 6, 7 years, however long the term is, ultimately the money's gone. Either way, the money's gone and you're left with the 5, 6, 7-year-old car. One costs you interest, one doesn't. With this, at the end of 5, 6, 7 years, of course, you're still going to have a 5 or 6 or 7-year-old car. However, you're going to have that $25,000 and then some back in your private bank. And this is how we keep the money circulating. We stop paying interest and we start earning it. You stop paying it out to somebody else. You keep it within you. You circulate the money the right way. This is what the wealthy have been doing for well over 100 years, and I am introducing it to Middle America. So I hope you completely understand exactly what I mean by this, because this is so important that you get this. You could become your own private family bank. Now, it doesn't happen in the first 6 months. It takes a little time to build up. But think about how much further along you'll be as far as saving money. It could be for retirement. It could be for anything. It could be for a kid's college if you didn't have to pay interest ever again to a lender. Think about that. So I hope that was extremely helpful for you. I hope now you understand what it means to purchase a vehicle outright versus financing it, and the power of not having to pay a lender ever again, and keeping that money within your own private banking system and letting that money circulate. To have more information, to learn more, just click the link in the comments and I will be sure to be in touch with you. You can schedule a chat right directly on my calendar and I will be there to help in any way that I can. In the meantime, give this a share, give it a like, and have yourselves a great day. I'll talk to you soon. Bye-bye.